Welcome to More Financial Talk. I'm Ryan Moore, and with me today is co-host Jaclyn Gladhill. How are you today, Jaclyn?
I am great, Ryan. I'm missing Tony, and I'm sorry he can't be here today, but hopefully I'm the next best thing. And it's officially fall. I mean, can we start off with that? I'm mourning summer a little bit. How about you, Ryan? How are you today?
Yeah, doing well. So hopefully Tony's up to something fun, but we're super happy to have you today. And yeah, fall's upon us. School's back in action. Got the kids all off in their sports. I mean, we're running a little crazy here with all the activities. We got our two daughters are both playing soccer. One of them is doing gymnastics on top of that, and they're both running cross country for their school. And our 13-year-old just got roped into like a skeet shooting team. So, and she just had her first practice on Saturday, and the skeet shooting coach is already calling her a natural. And apparently, we learned there's a lot of college scholarship money for this sport, which we did not know about. So maybe we'll be cultivating a little talent there. But all good stuff. Just hopping left and right with everybody's activities, but keeps us busy and out of trouble, right? So
Yeah, that's a lot. I
That's a
mean,
lot.
that's a lot of activities. And cross country, I am not a runner. So I give props to whoever does cross country, honestly. And Ryan, we have a guest today. Would you like to introduce him?
yeah, so we're excited to have Keith Gangl back on for another session with us today. Keith is the senior portfolio manager at Gradian Investments and a CFA with tons of industry experience. He's even won a couple of awards in the industry over the years for his dedication and success at what he does. So welcome in here, Keith. How are you?
Yeah, thanks for having me, Ryan. Glad to be here. It's been like you and Jaclyn said, it's been a busy fall. I to school. I actually sent my last youngest off to college, so we're officially empty nesters. Got 3 in college. That's a little bit of a sad fall. Not only is the weather changing, like Jaclyn said, in mourning for that reason. We
Yeah.
also got the transition at home, so I'm trying to figure that out going
Yeah,
on.
feeling like a quiet household?
It is my wife and the dog, I guess. We're down to 2. I like the chaos when the kids come home from college, so I kind of like the dynamics going on when the kids are around. So
Sure.
we'll get used to it, though.
Fall will fly by, and then you'll have your kids home for the holidays,
Yes.
and then you'll say, okay, get out
Yeah,
now.
yeah, and then go back.
Yeah, well, our youngest is 6, so we got a ways to go
Oh,
before
you got
being
you got
empty
a
nesters.
ways to
Yeah.
go. Yeah, yeah.
Is
Plus, you're busy.
Yeah, so 6 is what, 1st grade? That's a
Yeah, she
kid
just
year.
started first grade. That's right. Yep.
That's big.
Wow.
That's exciting.
Yeah, she's loving it. She loves school, so that's good. She
That's
didn't
a
get
good
that from
start.
daddy.
You got the skeet shooter, you got love in school, you got cross country, you got gym. My one daughter was a gymnast, so I know how much dedication and hard work that takes a lot of time, not only by the kids, but the parents as well, shuffling them around until they can drive.
Yeah.
Yeah, fortunately, my wife works in the business, which gives us a little flexibility for her to be able to run around and, handle all their endeavors, but while also working remote or coming into the office. So it's great having Chelsea with that flexibility. It's worked out well for our lives, for sure.
For sure.
For sure. Well, Ryan, where are we going to begin today in our conversation?
Sure. So I think we're going to generally just kind of doing a market update, a little market outlook, and kind of pick Keith's brain here a bit on how he's looking at things as we're, rounding out the year. This year's been going by fast, and we're about to wrap up Q3 here at the end of September. So just trying to get a gauge on where we're at. There's no moving parts at all going on in the markets right now, right, Keith?
Just normal, steady Eddie, just like every month. Wouldn't it be nice if we came in and we knew the markets would be up, 70, 80 basis, 100 basis points a month, get that nice 12% return a year. That'd make our lives a lot easier, wouldn't it?
Sure.
It doesn't work that way. There's always concerns going on. We got, stuff with the Fed, the jobs, inflation. The biggest question going on right now in the markets is what's the Fed going to do? Are they going to cut, or are they going to pause? And I'm sure we'll get to that in here a little bit. But the market's been great. It's the last 2 years have been fantastic. When we're referring to the market, when either you hear from myself or generally the media, they're referring to the S&P 500. The S&P
Right.
500 last year was up, 25, 26% for the last 2 years. And this year, kind of one of our outlooks, and we'll delve a little more into that, is kind of, the year of the umbrella. It's going to kind of be a rocky, could potentially see some storms. Make sure you work with your advisor, and Ryan can have a well-diversified portfolio because there could be some pullbacks. And what do we see in April when the tariffs got announced? We saw a pretty big pullback with markets almost dropped 20% in a matter of a few weeks. Markets were nervous. Investors didn't know what was going on. And we've kind of rebounded from there nicely. We're setting all-time highs in the market as well. So it's been a nice year overall. Year to date, I think the S&P 500 is roughly around 10%, which has been a fantastic return. I mean, that's kind of like the normalized 10 to 12 over long periods of time. But the fact that we've had two plus 25 years, that's nice to see this follow through.
Yeah, it's easy to get used to 20+% a year, though, isn't it?
That would be nice if we could do that, Dial, right? A few years of 20% plus, and you double your money and you keep on doing that. That would make life a lot easier for your clientele, that's for sure. But it doesn't work that way. There's always concerns in the market, like you mentioned. It's, again, the hot buttons right now where I would say it's inflation. Is it coming down? I think I'm in the camp it's coming down. The next question is job market. Is the job market softening or not? There's a little bit of softening, but we still think the economy overall is on a solid footing. And then what does that mean for the Fed, right? Because investors generally like rate cuts, and the Fed's thinking about going, we just had the Jackson Hole meeting, which is an economic update from the Fed. And they kind of hinted at they'd start resuming the Fed cuts. And again, we can get into a little more details on that later.
Well, let's dive into that now while we're touching on the topic. So many are saying possibly 2 to 3 rate cuts by year end, with potentially the first coming up here in September pretty quick. And that's usually, a tailwind for equities. What are your thoughts on, the amount of rate cuts, and are we looking at 25 basis points or 50 basis points here in September?
Yeah, that's a great question. Right now, the market probability, in which I agree with, I think it's going to be a 25 basis point cut. That's middle of September. I believe it's the 17th is when the decision will actually kind of be made. Right now, the decision, right, the Federal Reserve has a dual mandate: full maximum employment, which, again, unemployment right now is around 4.2%. I think the job is kind of starting to weaken a little bit. I think we'll tick up a little bit. So, but it's still pretty healthy, right? And the other is stable pricing, which is measured by inflation. You remember, you and I have been doing this for a while, right? But if you remember 2022, what was Jaclyn, remember what everybody was referring to in 2022, or what everybody was worried about?
I don't.
Inflation. Do you remember inflation?
Well, inflation is still an issue.
Right?
So we started hiking rates.
That's the most consumers thing. It's still an issue, and that's exactly. But inflation back then, when you mark year over year, was at 9.1%. The Fed's target's 2%. Right now, we're at 2.7%. So it's working its way down to 2%. I don't think it gets 2% anytime soon. And so the problem, the Fed has a balancing act, right? So if they raise rates to slow inflation, that slows the economy. That's exactly what happened. And then now what's happening is some people are arguing that the Fed's too tight, which means they want the Fed to lower rates, which would help stimulate the overall economy. That's good for, Ryan, housing market, right? So it's like
stuck in mud,
right? So if you want to move, it's hard to do because interest rates are higher than where they were a few years ago, and a lot of people can't move and things like that. Lower interest rates is obviously good for the consumer. Mm-hmm. It's maybe not as good for maybe some of Ryan's clients with, that have money in savings accounts and short-term money. That's a slight negative. So there's a balancing act. So the Fed's got to, if the economy is slowing, they'll want to cut rates, but they don't want to reignite inflation. I don't think they're going to do that right now. Reignite inflation, that is. I do think that the market's kind of got it right at about a 90% probability that we see a 25 basis point cut. Your second part of the question is how many cuts before year end? I'm in the camp of 2. I like to keep kind of some dry powder of the Fed if they don't cut as much, that if the economy really starts to slow, they can actually start cutting a little more aggressively, that 50 basis points, which that would then in turn spur the economy. Because I think the economy as a whole is pretty good right now. So I don't think they had to do a whole lot of stimulus, but I think indication of 25 basis points now would be healthy.
Yeah, I know many other nations have already cut rates a few times this year. And, from what I've heard from Chairman Powell, his hesitation is the tariff effect, right? Yep. Tariffs have been a big news item for this entire calendar year, pretty much. And so, that's when I've started to hear that word transitory again, which, if you remember back in 2022, we heard that a lot, and that did not ultimately play out to line up or match up, right? That wasn't really transitory inflation. Do you deem what's going on with tariffs to be more transitory, or,
I think they're more one time in nature, and once you're used to them, that kind of sets that new level higher. And again, there's a lot of news on tariffs, and we just had the other day that, they're supposedly, one of the judges said that they're not legal. So right now there's the big battle of, is it going to go to the Supreme Court? I mean, this could drag out 6-12 months. And that all goes back to, Trump and the first kind of when they announced these massive tariffs increases back in April 2nd, which they call Liberation Day. Only thing that liberated people was from their wallets that first month for sure, because the markets didn't like it. Markets sold off pretty aggressively. Markets now, I think, have come around to say, okay, Trump's using these tariffs as art of the deal, not economic chaos. And that's actually a good thing for the U.S. economy. I think that's where we're at right now. Now, the one thing that, Chairman Powell and some other people are worried about is that these tariffs could cause inflation, right? Because a tariff is a tax. It's just a matter of who's getting taxed. It's either the three people that can get hit by the tariffs are the exporter from the foreign country, the importer, whoever's importing, the retailer who's going to sell it, or the consumer. You're hearing a lot of media people saying that all that tariff's going to land on the consumer. That's not the case. It's going to be split between the three. Now, there's certain products that will, maybe a majority of it lands on the consumer, but there'll be other stuff that whoever's selling the product, the person buying it can maybe buy a substitute product. So they won't be able to pass that whole tariff on as well. So I think, generally speaking, tariffs help level the playing field. And I think that's kind of where Trump's going on, trying to do that with that. But again, and some people argue that, yeah, it may do that, but it's going to cause inflation. We haven't seen signs of that yet. So that's why I think that Chairman Powell is a little more hawkish, and he's coming around to the camp of actually, kind of Jackson Hole was just a few weeks ago. That's kind of an economic symposium that he kind of hinted at the fact that they actually will have a cut here coming middle of September, which is, again, a little bit of a change in his tune. So he was more hawkish on inflation. So I think he's kind of putting that in the background. We've seen a little bit of a softening jobs market. Again, by cutting rates, that'll spur the overall economy, which is good for the U.S. consumer. That's one of my big mantras, is diversification, and, working with you, all the different plans, the different portfolios you have. But the U.S. consumer, no one can spend like the U.S. consumer. So if the U.S. consumer is working, they have money in their pockets, they will spend. So again, with cutting rates, that could spur the economy a little bit, more people working, and people just love to spend.
Yeah. Well, me too. I love to spend too.
Right?
But Ryan, you mentioned transitory, right?
Transitory, yeah.
Can you explain to our listeners what that is?
Well, I understand it to be more of a temporary inflationary increase as opposed to something that's going to be more sustained or prolonged or continue to go up, which is, what we first heard in 2022, which I don't think that was an accurate message, as it did go up and sustain. What I hear a lot, Keith, and, help me out on this, is many of the pundits which have been negative about this tariff rollout because of anticipated, issues with inflation. But, it's been months now, and ultimately we haven't seen that. And many have even sort of reversed course to their sentiments. And I think there was a precedent with this back in Trump's first term in 2018, when there was he was going at it with China, with trade wars and et cetera. And we did have a big market correction in the fourth quarter of 2018. But we didn't see a spike in inflation back then. And ultimately, the market bounced back very rapidly in 2019. So do we feel like this is just a similar, replay of what we saw prior? Obviously, there's a lot more going on with many more countries involved. But ultimately, what's your take? Is it been a little overblown, or do we feel okay that inflation's not going to reignite?
I think it's been a little bit overblown. And the other thing that people like to, I don't want to talk politics one way or the other, go down the rabbit holes on that. But if you go back to, you did a good job of kind of laying out the question. Is in 2018-19, when Trump first introduced the tariffs, kind of market kind of freaked out a little bit. It sold off. He was targeting China, like you said. Now he's targeting pretty much everybody. We have a thing called the effective tariff rate. For the last 100 years, that's gone from like 20% 100 years ago down to basically 1%. Globalization, free trade. We don't use in the U.S. tariffs very often. Other countries were using them against us, ironically, but we weren't using the tariffs against them. The effective tariff rate was 1%. Trump came in, raised them. He's targeting China to get their, China was a huge trade partner, by the way, with us back in 2018-19. They were about 23% of our goods coming in the country. Now with the tariffs that he added on, that has shrunk down to 13%, 8 years later. And the funny thing is, about if you don't like tariffs, what do you think the following administration, Biden's administration, came in? they actually kept those tariffs in place, right? I think there's a place for them if they're used strategically. Now, you just don't want to. Again, they're a tax. Don't get me wrong, and someone's gonna have to pay them. But if you can get some kind of economic concession out of a different country or a company, I think if they're well placed, they could be useful. And then the opposite side of the argument was that, well, tariffs are a tax. Tax is going to be inflation. Inflationary is bad. We don't want to. We ever remembers what happened in 2022, except for Jaclyn. She didn't remember what they did. She knew things are expensive because inflation's still around, and she's right. Inflation's still around because the prices, once they go up, they don't ever seem to go down. It just every year they're going up a little bit less. So she's absolutely right about that. So we do have still relatively higher inflation, but at least on a year over year basis, it's, that 2.7% is what I mentioned. So that's kind of, expected, not terrible. So I think right now, I think that the inflation fears are overblown. To your point, it's been 4 or 5 months since they've been in place. And you would think you would have seen a little more signs. I do think it's going to hit some industries more than others. One area that you obviously that like retail, like consumer, kind of think about apparel goods coming from some of these countries that we don't make shirts and T-shirts here and pants, those type of things. If you get added a 25, 30% tariff on it, somebody's going to eat that cost. It could be part the consumer, maybe part the reseller, and part the exporter. I think it's going to be a combination of the three, because consumers will find alternatives if something gets priced too high. So that's where I think that's going to kind of be the argument against inflation running wild, like that they're fearful of. Now, that being said, I'm also in the camp of I don't want to see cuts just willy-nilly of cutting to grow the economy too fast, because then you start overheating as well. And I do think we're on fairly solid footing. I do think the jobs market's slowing a little bit. That's why I'm fine with a little bit of cutting here, but I just don't want them to be too aggressive. I think if the Fed would cut 50 basis points in September, some of the investors may, I like Fed cuts, but that's too aggressive. What's going on? Is the economy really slowing down that much? And maybe, that's kind of a little perverse. Maybe the market would sell off.
Yeah, I need to step it down gradually. Okay.
Yep.
Well, hey, let me pivot slightly. I still want to stay on the tariff topic, but I want to touch on international investing. Okay. So with that, coming off of the conference that we had with you guys earlier in the year in June, where we talked heavily about, market conditions, and what became glaringly obvious to me was that international largely is back in terms of considering greater exposure, more diversification in that space. Specifically more in developed markets than emerging markets. That being said, I've had a lot of review appointments with clients, and we have been allocating more back to international. But a common question there is going to be, well, what are the tariff effects as it relates to international investing, since these are the countries that could be facing greater tariffs? And I know you and I had a couple chats on this, but I'd love for our listeners to hear your take on the tariff effect as it relates to international investing.
Sure. We'll set the backdrop of just kind of the performance. Like I said, the U.S. market, S&P 500 is up about 10% this year. And you're exactly right. International markets, I think, the developed markets are up almost 25%. That's a pretty big delta. Again, they've lagged for the last several years, if not over a decade. So their valuations generally cheap on them. I think investors are coming around to them. Also tying into that, which we just talked about, our U.S. our Federal Reserve cutting rates. International, they've been cutting for quite a while. I think they're on their 8th cut now. So they've cut about 200 basis points off their ECB, their Fed fund rate, which is also helping their market as well, right? So that's part of the dynamic that's pushing their market up as well. Not related to your question on tariffs. Yeah, tariffs are going to be paid by somebody. It's going to be, the exporter, which could be those foreign countries, and those companies within those foreign countries as well. But again, I think everybody's going to manage it. Everybody's going to look at their margins and can they keep them or not. Yeah, the other thing with international is the sectors are different in the developed markets, internationally developed markets versus U.S. markets. U.S. obviously one of the reasons that the U.S. market has been so much better than the international markets has been our technology companies. Technology makes up about 30% of our sector or industry exposure. When you look over at the international developed market, they're more industrial, more financial service oriented. And those companies, when the ECB is cutting rates, those financial companies generally do well. Their industrial activity picks up. So I think those things will kind of offset any kind of negative impact they would have from tariffs as well. So again, tariffs are a tax. Somebody's going to pay them. I mean, obviously the U.S. hopes more of the foreign companies pay them than the U.S. consumer pays them or the U.S. companies pay them. But it's certainly going to be a mix, and it could have a slight impact on maybe a few of the companies over there. But generally speaking, I think all companies will manage how they can get through these tariffs.
So I think part of what I heard from you prior was that when you just look at the different markets, international versus domestic here in the US, as it relates to valuations, and that's where you see opportunity, is that, things are trading at a little bit more of a discount, so to speak, internationally.
Oh, for sure. Like if you look at one of the easy metrics to look at valuation, if you're just doing the overall market, again, the S&P 500, the valuation metric that we use as investors is a price to earnings ratio. That's at about 22 times multiple. That's your forward earnings divided by your price of these companies in the S&P 500. Now you look at the international markets, that multiple is more at 13, 14 times. So that's a 8-point spread between, U.S. markets and internet. That's a pretty big spread. Doesn't sound like a lot, but that's a lot. I mean, literally, you could have international markets double, say their earnings didn't change at all, and they would go from that 13 times to 26 times, right? So that'd be a doubling, and then they'd be at 26, we'd be at 22, all things being said. So that's where how big of the 8 points on a multiple, that's a pretty big spread. And that's where some investors been pretty excited, and they've been, the valuation argument's been there for a few years. So again, now what is the catalyst? I think the catalyst is that their economy is actually starting to do pretty well. And I think part of it's due to the fact that they've been cutting interest rates here for, almost over a year. And so they're kind of a little bit ahead on that. Now they'll have the same argument, and they'll have to worry about inflation if they start cutting in too aggressively, right? Are they going to reignite inflation over there, which is an issue? I think right now, it seems like they've hit the fine balance of the right spot. So I think they're fine on that. And so, but I think it's an area that we generally want to have some allocation to it, right? We wouldn't want to be like having, if you were 75% allocated to the U.S. companies and 25 outside of the U.S., I don't think you want to flip that and say, I want to be 75% outside of the U.S. and 25 for the U.S. Because, again, that technology argument I just made to you a little while ago, or talking about the sector weighting, I think those large mega cap tech names continue to work, especially when you look out 3-5 years. But certainly these international companies that are cheap can start working here. And that's why you do a great job with your clients, kind of making those allocation decisions that there's an opportunity there. We think, we'll allocate there. We can revisit that in, a year and say, okay, this is done well. We continue to stay with it. Or maybe we'll say rotating back to maybe there's more opportunity in the US, or maybe somewhere else there's going to be an opportunity.
Yeah, and I think the way I try to explain it to our clients is through the benefits of working with a group like Gradian. It gives us the ability to have active professional money management, which I describe as the ability to move in the direction of opportunity and momentum as it relates to the markets. And also a big part of what we do is risk mitigation, which I think is equally as important, is to minimize the downturns when many in passive investments like mutual funds tend to bottom out when markets correct and then have a longer time to rebound. So we commend you guys for what you do and all the tools that you bring to us and to our clients that really, I think, help our folks sleep better at night, knowing what's going on with their money, and that we do have a plan, and that we ultimately plan for the worst and hope for the best. That way, if the worst happens, we have a plan. But if you plan for the best and then the worst happens, I think that's when people get in trouble. So you guys bring a lot of those tools that allow us to navigate challenging times in the market and also capitalize when things are good. And so we commend you for that, Keith. So moving on here a little bit, we want to round out a couple more discussion points. So when you were talking about big tech names and some of the big companies, recently in the news was a Google outcome for some antitrust ruling that ultimately had come down, which I think had a big impact on their stock price. But this also spilled over into the world of Apple. So just maybe a quick take on what the takeaways were on that.
Yeah, no, that was a key point just the other day. It was there's a ruling in favor of Google with this, and there's always antitrust, especially when in the international developed, the EU, against large tech names. There's always some kind of legislation, and always looking to try to extract something from these large tech companies. But anyway, a judge ruling was in favor of Alphabet or Google. They did not have to sell Chrome, which the investors, myself included, really liked that. It was like the stock that day was up about 7%. it's a big move. And obviously talking about these large tech names, Mag 7, that's certainly one of them. And the other thing with Alphabet, and it's a name we like and we own several of our portfolios, it's a name that on a valuation, I told you, remember the valuation of the international markets at 13 times PE, the US markets at 22 times. For a large growth name, this down to the overall market was trading at 20 times. So it's because of these overhangs, and now the overhang got lifted, you see that nice 7% pop. Now, did we know that was going to happen? Absolutely not. We like it for other fundamental reasons as well, but it surely helped things. And you touched on it as well. It also helped Apple, because Apple is the endpoint consumer for Jaclyn. Do you have an iPhone or anything like that?
I am an Apple girly.
Yeah, see, everybody is. And so they're kind of the gateway of, all this AI technology. Are they going to develop their own or not? And Alphabet, paid them, I think it was $20 billion last year to be on their, on the
Wow.
So a big number. And what could have happened is that 20 billion could have potentially went away if Apple had developed their own things. But now that helped Apple. Now they can say, okay, well, we'll use maybe Alphabet, maybe we'll use somebody else as well. And Anthropic and all these other AI things can go through Apple a lot easier. If this suit would have went through, that wouldn't have been the case. So Apple had a nice positive move as well. And Apple's another one that's actually, a rank over our 1 to 7. It's not near the top, but it's certainly becoming cheaper. The valuation now is kind of that 23, 24 times. So it's not much above the market multiple. And then we heard from Jaclyn, she's a, iPhone,
Apple Watch,
She's
computer,
in the
everything.
computer.
The Apple Kool-Aid, right?
Yeah, no different from my household. Just so you know, I would think my 3 college kids would just really disown me if we started cutting off the iPhones or the Apple One program.
And once you're in, you're stuck. You're stuck.
And that's why, to the point,
You get your hooks in. They get their
sums
hooks into
it
you.
up well, because Apple used to be a device company, sell these devices every 2-3 years. You get a new one, $1,000, blah, blah, blah. That was kind of the driver for them. But now about 30% of their business is all these services they wrap around them. And those are very profitable, because, margins on hardware is, 20%. Margins on these services are around 70%. So it's a lot higher margin business. So that's why Apple is a key. And a lot of people, again, we own it. We like it. And that's why, because it's hard to go away from Apple. And that ruling, I think, helped solidify that as well.
Okay. Are you seeing markets broaden out beyond the Mag 7, where so much of the growth concentration had been with those, big 7 companies? Are you seeing more of a...
Yeah, we're seeing fits and starts of that. We've seen in the beginning of the year where all of a sudden the market started to broaden out, which generally speaking, investors like. We just, because with Mag 7 make up about 30% of the overall market. That's kind of what's been driving the market. So as investors, we like to see that kind of broaden out, because that's 30% in 7 names. That's a lot exposure, right? So we like to see other names participate, and they're starting to do that as well. So we'll wait and see. Right now, recently, what's been working for the last month and a half has been a small cap trade. It's kind of like the international trade, where it's been lagging. International has been lagging for a decade. Small cap stocks have been lagging for a decade. But now there's this last couple of months, they've been starting to perform. Again, their valuation trades at 13, 14 times the profitable company. Only problem with small caps is a lot of the small cap names are not profitable. So if the market starts to slow down a little bit, you start going to a little bit of an economic slowdown, small caps don't work. So I still like that, the larger mid cap with some exposure to that. And that's kind of what in some of the portfolios we have as well, kind of a little bit of a blend, but still tilted toward that mid and larger cap names. But small caps, they could, surprise a little bit. And again, they're from depressed valuations as well.
Yeah, I would think small caps would benefit from some rate cuts where they can, be borrowing capital at a lower cost, which could boost growth and ultimately revenues.
Yeah, it's like yourself, small business, right? I mean, it's easier to borrow money. It's easier to open a business and do like that. The only thing is it's a balancing act, just like the Fed's balancing act between full employment, inflation. Small caps, you're exactly right. And that's why they've been moving, because the Fed's hinting at this rate cut, which they do move towards that. But the thing is, if economy gets worse more quickly than the Fed or the rate cuts kick in, those companies aren't prepared for that, right? Because they don't have very strong balance sheets. Then you could see some, small caps get out of favor. I don't see that happening. I think we're more into we're in a steady economy. We're starting to see some more green shoots that we could actually start growing a little bit faster. I think when we look at, end of this year, we're getting towards the end of this year, but at least in the first half of next year.
So a lot of moving parts upon us, which is typical for markets. But what would you say, as far as, just to kind of round out our time together, if you were to provide any sort of forecast on the remaining part of this calendar year, do you think we'll be finishing strong? Will we just kind of staying range bound? What are your thoughts there?
Yeah, I think it's going to be a little. Again, it's only 4 months. If I had my perfect crystal ball in front of me, again, we'll see.
Magic 8 ball, right?
Magic 8 ball. I've been doing this for 30 years. It's hard to predict that, but I do think the market will be a little bit higher at year end than it is now. Simply, but I do think we'll probably have a little bit of a pullback here. We saw it the other day, the beginning of September, the markets were off, 1.5% in a day. I could see a 5, 6, 7% pullback, but I think that'd be more of a buying opportunity. Again, we don't like to. That's not how we operate, and then it's not how you don't try to time it with markets, but that's just kind of my gut feel that we could have a little bit of a pullback. There'll be some news source, but I think even if we do have some kind of pullback like that, I think seasonally September is generally a weaker month anyway, and then we get into November, December, they're usually really strong. You get, again, to my point of the U.S. consumer spending, they spend come November, December, which drives the overall economy. I think that's why I think the market will finish higher than this. And then we'll start, looking at giving forecasts for next year. And again, if say the market finishes roughly where we're at, then we'd have a 26, 25, 11, 10, 11, 12% return this year. Just based on that and kind of where we are today, fundamentally, I would expect that normalized year. We never get that normalized year of 10 to 12, but that's my gut. When we look out 18 months is kind of, we're still in a good place. The tariffs, there's a lot of news going on tariffs. We could have a whole nother show on tariffs. So kind of, are they legal? Are they not? Is the Supreme Court going to see them? Are they not? Are they going to impact what Donald Trump can do from the negotiating standpoint? I think that would be one thing that could spook the market if something kind of that tariff, kind of quiver gets taken out of his arsenal. That could maybe also people, even though he didn't like him at first, you may like the fact that some of the things that he's doing with them.
Well, and Keith, what you just said too, I mean, that just reminds me the holidays are coming up.
Yeah.
Don't remind me.
They're right around the corner.
Right. Spending money. And
we know we can get Jaclyn another Apple Watch or something.
Yeah.
We'll be pushing for a Santa Claus rally before you know it, right?
Yeah,
absolutely. Well, guys, this has been a great episode. Ryan, is there anything else you want to add before we close out for today?
No, this has been great. I just want to greatly thank you, Keith, for taking the time today. And, we value you tremendously with what you do for our company and our clients, and really appreciate your knowledge and experience. So we just thank you for taking the time today, and we'll catch up with you again down the road, get another outlook when the timing permits.
Sounds good. Thanks for having me.
Ryan, how can listeners get a hold of you?
Yeah, so we can be reached directly via phone through area code 615-467-6300. You can also email our office at info@rsgtn.com. Additionally, our website to check us out is rsgtn.com.
Well, thank you, Ryan. Thank you, Keith. This has been fun for me, and hopefully I didn't, make it too bad without Tony. So I appreciate it, Ryan.
Tony who? What?
Tony may not have a job next week when he comes
back. Yeah. You were great, Jaclyn. Thank you so much.
Well, thank you, Ryan. All right. That does it for this episode of Financial Talk with our host, Ryan Moore.
Thank you.